My name is Garth McKenzie. I'm a technical analyst and an ETF strategist with traderscorner.co.za. Today, I'm taking a look at the S&P 500 as I do each week and having a look at the levels where the market has traded up to over the last week and where I think it might be headed from here, because I think we could be at quite an important inflection point on the market at the moment. So if we take a look at my first slide, it has a look at the S&P 500. It's a daily chart. And what's really notable here is the 2850 resistance level that I've alluded to in the past. That is significant because it marks out the prior lows in August and September and October of 2019. We saw the market crashing through that level in March of this year, but it's now rebounded very strongly and we're now back up and retesting that level. What's also notable about that level is that it's the underside of the 50-day moving average. And I always like to see that as an indication of medium-term trend or medium-term direction. The next chart is also a daily chart of the S&P 500, but it just zooms in more closely on the more recent trading activity. We've got 4 months worth of trading action here. So what it shows you is the peak that we saw in February, followed by the crash into March of this year. And what you can see over the last month is that the market has staged a pretty impressive rally. It's now nearly 30% up off the lows that we saw in late March. But what's evident here as well is that that rally has been happening on declining volume. And there are a couple of other interesting points to mention over here. So I'll go through them one by one. The first at the top of this chart is the negative divergence on the stochastic oscillator. What that indicates is that the market's been making slightly higher highs, but yet the oscillator's been making lower highs. And that very often is an indication that the speed of the rally is starting to run out of momentum. And that can sometimes preempt a change in trend. So what that would suggest is there's a possibility that we see a shift to the downside here. Also notable is that the market rallied into the underside of the 50-day moving average, and yesterday it actually formed quite a clear bearish hammer reversal pattern off of the underside of that 50-day moving average. The area between the 50% and the 61.8% Fibonacci retracements has also been challenged over the past week. And I've referred to that as the ambush zone. In other words, it's the area where we might start to see some profit taking emerge and possibly some new shorts being entered into the market. The last thing to point out is that this large rising wedge that we've seen over the past month is typically seen as a continuation pattern, and those patterns do generally break to the downside. Not always, but more often than not, they break to the downside, and particularly when they form in a declining trend, as is the case here. So what we'd need to watch out for is a break out the bottom of that rising wedge pattern, which could then potentially set the stage for a move to the downside. Now, my next chart is an hourly chart of the S&P 500. And what I'm looking at specifically here is the negative divergence that has been evident on 2 of the indicators. So at the top of the chart, we've got negative divergence on the RSI, the relative strength index. That's where the index has been making lower highs, and yet the price of the index has been making higher highs, but the indicator has been making lower highs. If we start to see the RSI dropping out below 50 on this hourly chart, then I think that possibly signals that we'll see a deeper sell-off in this market and a bit of pulling back from this recent strength that we've seen. And then at the bottom of the chart there is the ADX. That is the average directional index. And there's also quite clearly negative divergence evident over there. Whilst the market's been making higher highs, that indicator has also been making lower highs. So not confirming the rally that we've seen in the market lately. My final chart today is again an hourly chart of the S&P 500. What's evident here again is the negative divergence on the stochastic oscillator at the top. And again, in the chart index itself, you can see the rising wedge pattern that I've alluded to previously. What's critical here is that the market looks as if it's now starting to break down below the 15-period exponential moving average on that hourly chart. If it continues below that 15 EMA and it starts to move below 2750, then that would mark a breakout the bottom of that rising wedge pattern. And it could then signal further weakness down towards the levels that I've indicated on that chart. So 2650 would be your first stop, then 2500 where there's a big gap in the chart. So I think that's where we could be headed in the near term if the weakness that we've seen over the past day or so persists. That's all I've got for you this time. I'll be back later in the week with a look at the more ETFs and some more market analysis.